IAS12 calculates deferred tax liabilities. But how do you predict a company's future tax bill years before it's actually due? Let's say you buy a factory machine that loses value differently on your financial books versus your tax return. On your accounting books, its current value is simply its carrying amount, but the government has its own rules for how much you can deduct, and that government-approved value is called the tax base. Because governments often allow accelerated deductions to encourage investment, the machine's tax base shrinks much faster than its accounting carrying amount. This creates a physical gap between the two ledgers. Because you've used up your tax deductions early, you're mathematically guaranteed to owe higher taxes later. IAS12 calls this specific gap a taxable temporary difference. To lock in that future cost today, you multiply this exact gap by the corporate tax rate, creating a formal obligation for taxes owed tomorrow, a deferred tax liability. So what happens to that original factory machine with the mismatched depreciation rates? Its inevitable future tax burden is now safely locked onto the balance sheet, telling the complete financial story today.